Hello everyone, I had to start investing in the AI boom today from scratch. Knowing what I know about the power shortage, the data center race, and what is coming over the next few years, I would do everything differently. Most people think this market is about picking the right chip stock or somehow catching the next software winner before everybody else sees it, but that is not what this is about anymore. We are living through the biggest electricity build-out in modern American history. The models are getting larger, the servers are getting hotter, the campuses are getting bigger, and the old grid was not built for this kind of load. If you position yourself correctly, you can ride the second wave of AI, the one hiding underneath the headlines. But if you do not, you might own the exciting story and still miss the companies that make the story possible. Today is Monday, May 4th, New York date, and comment below what day and date you are watching from, because I always want to know where this conversation is reaching people. And if you value this kind of work, support the channel by subscribing and comment John AG Best below. It is a quick signal that you want the real breakdown, not the surface noise. So in this video, we are going to walk through 3 stocks that may become the power side winners of the AI boom, and 2 names I would be careful with, because not every company with the word energy or infrastructure attached to it is automatically a winner. That is the trap. The market loves simple labels: AI stock, power stock, construction stock, clean energy stock. Lovely. But the money is usually made in the detail that most people skip, so let's get started. Now, the first thing you need to understand is very simple. AI does not run in the cloud. I know everybody says cloud. It sounds clean and weightless and wonderful. But the cloud is a warehouse full of machines, and those machines need power every second. They need cooling. They need backup systems. They need substations. They need transformers. They need gas turbines, fuel cells, grid equipment, engineers, permits, land, water, and time. And time might be the scarcest thing of all. Based on recently published numbers, global data center electricity consumption is projected to roughly double by the end of the decade, and the United States is one of the biggest pieces of that growth. In America, electricity demand is now expected to grow in a way we have not really seen since the early 2000s, driven largely by large computing facilities. That is not a normal utility footnote. That is the foundation under the AI trade. So when people say AI stocks are running, my question is, running on what? Because if the chips are ready but the power connection is not, that is not a computing problem anymore. That is an energy problem. And this is why I think the next phase of the AI trade moves from the glamorous layer to the physical layer. Not because chips stop mattering, they absolutely matter, but because a chip without electricity is just a very expensive paperweight. And here is where the story gets interesting. The grid is slow, not useless, not doomed, not some apocalyptic nonsense. Slow. Interconnection queues are long, transmission takes years. Local communities push back when giant campuses arrive and power bills start becoming political. Data center operators do not want to wait around for every permit, every upgrade, every local fight, every transformer delay. They want power now, or as close to now as they can get. And another thing, the local politics are changing. A few years ago, a data center was mostly sold as jobs, investment, and a quiet building full of computers. Now residents are asking harder questions. Who pays for the substation? Who pays for the transmission upgrade? Who gets the tax break? Who absorbs the water use? Who sees the higher monthly bill if the utility has to build ahead of demand? Those questions can slow projects even when the technology is ready. That is why power is not just an engineering problem. It is also a community problem, a regulatory problem, and a capital allocation problem. And this is where the smartest operators are trying to reduce friction. They are signing power deals earlier. They are looking at gas, nuclear, renewables, batteries, fuel cells, and combinations of all of them. They are thinking about microgrids. They are thinking about private wires. They are thinking about whether the fastest path to compute is not waiting for the perfect grid solution, but building a practical power stack next to the load. It may not be pretty, but markets do not usually reward pretty. They reward available. That is also why I would not treat this like a one-quarter trade. This could be a multi-year scramble where the winners change as bottlenecks move. First it was chips, then it became power. Next it could be cooling, interconnection equipment, land, or skilled labor. The trick is staying curious enough to follow the bottleneck before the crowd names it. That is where the edge quietly begins. Right there. That is why behind-the-meter power matters. Behind the meter simply means the power is produced close to the customer instead of being fully dependent on the public grid. I like to think of it as bring your own power. You want to build the data center? Fine. But do not just show up and ask the local grid to magically feed a city-sized load tomorrow morning. Bring the power solution with you. That is where the investment map changes. The first company I would study seriously is GE Vernova. Now, this is not the kind of name that makes social media go crazy. Nobody wakes up and says, "Wow, I cannot wait to talk about turbines." But that is exactly why it matters. GE Vernova lives inside the boring machinery of the electricity supercycle. Gas power, grid equipment, electrification, services, the actual hardware needed to make power available. And in its own recent reporting, the company tied electricity demand directly to industrialization, advanced manufacturing, data centers for AI, and the need to upgrade the grid. That is important because every big AI announcement has a shadow. A cloud company says it will spend more. A model company says it needs more compute. A hyperscaler says it needs more campuses. Fine. Somebody still has to provide the turbines. Somebody still has to provide the grid gear. Somebody has to install, service, and maintain the equipment after the ribbon-cutting photo is over. GE Vernova also comes with a backlog story, and backlog matters in this environment because it tells you demand is not just a mood. It is orders, contracts, and waiting lines. The company reported tens of billions in orders for the last year and a backlog around the low 100 billion range. Again, do not get hypnotized by the numbers. The point is the direction. Demand for reliable power equipment is getting pulled forward, and AI is one of the reasons. Now, does that mean you blindly buy it after a big move? No. Please do not do that thing where a stock runs, you feel left out, and then you decide the chart is your personality. Valuation still matters. Execution still matters. Margins still matter. Supply chain still matters. But the thesis is clean. If the world needs more dispatchable power and more grid hardware, GE Vernova is not watching from the sidelines. It is in the room. The second company is Bloom Energy. This one is trickier because the stock has already had the kind of move that makes people either excited or terrified, depending on whether they own it. Bloom makes solid oxide fuel cell systems that can provide on-site power. And that phrase, on-site power, is the whole reason this company belongs in the conversation. Data centers want speed. They want reliability. They want a power solution that does not require them to wait years while the grid catches up. According to recent company updates, Bloom expanded a major partnership with Oracle to support AI and cloud infrastructure, with an initial deployment above 1 gigawatt and a master agreement that could reach nearly 3 gigawatts of fuel cell capacity. That is not small. That is not a pilot project in a parking lot. That is big enough to make investors take the technology seriously. And the reason this matters is not just capacity, it is time to power. If a data center operator can get usable power faster, that can be worth a lot. Because in AI, waiting 6 months or a year can mean losing position in a race where everybody is trying to secure customers, GPUs, land, and talent at the same time. Power delay becomes business delay. Business delay becomes revenue delay. Revenue delay becomes market share risk. But here is the counterpoint, and we have to be honest. Fuel cell stories have disappointed investors before. The technology can be promising and still face real questions around cost, fuel availability, maintenance, customer concentration, and long-term margins. A big order does not erase every risk. It just proves the market need is real. So if you are looking at Bloom, the question is not, is the story exciting? Of course it is exciting. The question is, can the company turn huge demand into profitable, repeatable, scalable economics? That is the part I would watch closely. The third name is Kodiak Gas Services. This one is less obvious, which is why I like talking about it. Kodiak is not selling a dream about artificial intelligence. It is a natural gas compression company. It helps move gas through the system. Boring? Sure. But when data centers need reliable power, boring starts to look useful. Natural gas is becoming one of the bridge fuels for this AI build-out because it is dispatchable. You can turn it on. You can run it when the sun is down and the wind is not cooperating. And in the latest energy outlooks, natural gas remains a major part of U.S. power generation, while demand from large computing facilities keeps pushing the conversation forward. That does not mean gas is perfect. It means gas is available, scalable, and politically complicated, which is basically the energy market in one sentence. Kodiak's core compression business can benefit if more gas has to move to more power projects. But the more interesting twist is distributed power. The company announced the acquisition of Distributed Power Solutions, adding a fleet of nearly 400 megawatts of generation assets powered by Caterpillar engines and turbines. That moves Kodiak beyond compression and closer to the behind-the-meter theme. So now you have two doors. Door 1, more natural gas moving through pipelines. Door 2, more on-site power demand from data centers, microgrids, and industrial customers. If both doors open, Kodiak gets more interesting. It is not as clean or as famous as the first two. It probably carries more energy cycle noise. But hidden industrial names can become powerful when the market suddenly realizes the bottleneck is physical equipment, not another app. Now, what should you avoid? The first one I would treat carefully is NextEra Energy. And this is where I want to be fair because the simple version of the competitor thesis is too harsh. NextEra is not some random weak energy company. It has a massive generation portfolio, including renewables, storage, natural gas, and nuclear. It is actively talking about AI-driven industrial demand and data center hubs. So no, I would not say it has no exposure. That would be lazy. The issue is whether it is the sharpest way to play the urgent AI power bottleneck. Data centers need power all day and all night. Solar and wind help, storage helps, clean contracts help, but intermittent generation is not the same as guaranteed baseload. The latest energy projections still show renewables growing strongly, but they also show natural gas, fossil backup, and nuclear playing important roles when demand spikes or reliability matters. So NextEra may be a good company and still not be the most explosive AI power trade. That is possible. A company can benefit and still underperform the more direct bottleneck names. Remember that. Investing is not just asking, will this company be involved? It is asking, will this involvement change the earnings power enough to justify the stock? The second name I would be careful with is AECOM. Again, we need nuance. AECOM absolutely works in data centers and digital infrastructure. Its own materials talk about hyperscale data centers, standalone power systems, advanced cooling, and water treatment. So the idea that it has no data center relevance is not accurate enough for me. But here is the risk. AECOM is a broad infrastructure and professional services company. Broad can be good, broad can also dilute the story. If investors are buying it as a pure AI power bottleneck play, they need to prove that the data center and power work is large enough, profitable enough, and fast enough to move the whole company. Otherwise, you may own a solid engineering business while the more direct power names capture the excitement, and that is the big lesson. Do not buy category labels. Buy exposure. Buy the company closest to the constraint. If the constraint is grid gear, study grid gear. If the constraint is on-site power, study on-site power. If the constraint is gas supply and distributed generation, study that. But do not assume every utility, every renewable company, or every construction firm gets the same benefit. If you are successful, share your success story in the comments so others can stay motivated. So the framework is simple. GE Vernova is the power hardware and electrification play. Bloom Energy is the on-site fuel cell and speed-to-power play. Kodiak Gas Services is the gas compression plus distributed power angle. NextEra is a real company, but maybe not the sharpest direct way to play the bottleneck. AECOM has real data center exposure, but I would want proof it changes the whole earnings picture. That is how I would think about this market. AI is not only a software race, it is a power race. It is a land race. It is a cooling race. It is a permitting race. It is a transformer race. And the winners may not be the companies shouting AI the loudest. They may be the companies quietly making AI physically possible. So do your research. Watch the order books. Watch customer announcements. Watch margins. Watch whether projects move from press releases into actual deployments. And please remember, this is for education and perspective only. I am not your financial advisor. I am not telling you to buy or sell anything. And your own situation matters more than any market story. Use this as a starting point, not a substitute for thinking.